What if I told you that the entire trajectory of the U.S. real estate market, the one that's been frozen, unpredictable, and frankly, unaffordable for millions, just shifted dramatically in less than a week? And that the catalyst wasn't just one event, but a perfect storm of three seismic economic shocks that rewrote the rules overnight? Welcome, everyone. For potential homebuyers, sellers, and investors watching this, the waiting game is over. The signals we've been desperately searching for have finally arrived. This isn't just news. This is a market pivot. And if you understand how these forces connect, you'll be equipped to make some of the most crucial financial decisions of the year. I'm John, and on this channel, we don't just read the headlines. We dissect them to give you the strategic advantage. We connect the dots between global economics and your local real estate market. This week, all eyes were on three monumental events. The shocking June CPI inflation report that sent Wall Street into a frenzy, Federal Reserve Chair Jerome Powell's crucial testimony before Congress, and a surprise political outcome in France that sent shockwaves through global capital markets. Independently, they're big stories. But together, they form a powerful narrative that is directly impacting mortgage rates, home prices, and investment strategies right now. Stick with me for the next 15 minutes. I'm going to break down each of these events in simple terms, but more importantly, I'm going to show you exactly what they mean for you. Whether you're trying to buy your first home, sell an investment property, or simply understand where to put your money next, this analysis will give you the clarity you've been waiting for. This is your frontline report from the intersection of economics and real estate. Let's dive in. CPI, the domino that topples everything, from inflation fears to mortgage rate relief. Let's start with the biggest story of the week, the one that truly changed the game. The Consumer Price Index report for June. The number was a stunner. Headline inflation came in at 3% year over year. Now, on its own, that number might not seem revolutionary. But context is everything. It was lower than the expected 3.1%. More importantly, it was a significant drop from May's 3.3%. And perhaps most crucially, when we look at the monthly figure, we saw inflation actually flatline at 0%. For the first time in a long time, the data didn't just show inflation cooling. It suggested it might be hitting a wall. The immediate, Pavlovian response from Wall Street was a massive rally. The S&P 500 and Nasdaq blasted to new all-time highs. But why? Because this data is the single most important input into the Federal Reserve's decision-making algorithm. For over 2 years, the Fed has been waging a war on inflation by aggressively raising interest rates. Their goal has been to cool the economy down. This CPI report is the clearest signal, yet that their strategy is not just working, but perhaps working better than anyone anticipated. The market instantly repriced its expectations. The probability of the Fed cutting interest rates at their September meeting skyrocketed from around 70% to over 95% in a matter of hours. This is the domino effect. Lower inflation expectations lead to Fed rate cut expectations, which leads to a fundamental repricing of money across the entire economy. And this is where we get to the absolute heart of the matter for real estate: mortgage rates. You see, mortgage rates, specifically the 30-year fixed rate, don't move in lockstep with the Fed's rate. Instead, they tend to track the yield on the 10-year U.S. Treasury bond. And bond yields are incredibly sensitive to inflation expectations and future Fed policy. When the CPI data dropped, the 10-year yield plummeted. It had been hovering around 4.3%, and it tanked, falling decisively below the psychologically important 4.2% level. This move is everything. For the past few months, the average 30-year fixed mortgage rate has been stubbornly stuck in a range between 6.8% and a terrifying 7.2% for some borrowers. That level created what we call the golden handcuff or lock-in effect. Millions of homeowners, sitting on mortgages with rates of 3%, 4%, or even 5%, simply refused to sell their homes because giving up that rate to buy a new house at 7% would have been financial suicide. It froze inventory and crippled market activity. But this week, that logjam began to break. As the 10-year yield fell, major lenders immediately started lowering their posted rates. We saw the average rate on a 30-year loan drop from that 7% range to near 6.75%, and the momentum suggests it could go even lower if the data holds. Let's put that into concrete terms. For a homebuyer taking out a $500,000 loan, a drop from 7% to 6.75% saves them about $80 on their monthly payment. That's meaningful. But if this trend continues and we see rates move towards 6.5% or even 6.25% by September, the savings become monumental, $200 or $300 a month, which translates to tens of thousands of dollars over the life of the loan. This isn't just a minor adjustment, it's a shift in affordability. It unlocks demand from buyers who were priced out. It gives sellers a reason to finally list their properties, knowing there will be more qualified buyers able to secure financing. It injects liquidity and activity back into a market that has been in a state of suspended animation. The CPI data was the first and most important domino to fall. The Powell put, how the Fed Chair's words calmed a nervous market. Now, while the cold, hard data of the CPI report was the catalyst, the market doesn't operate on numbers alone. It runs on confidence, on narrative, and on expectation. And that's where our second major event comes into play: Federal Reserve Chair Jerome Powell's semi-annual testimony before Congress. This is a masterclass in what economists call forward guidance. Powell didn't change interest rates this week. He didn't announce any new policy. But what he did was perhaps more important. He carefully managed the market's psyche and, in doing so, helped cement the positive momentum that the CPI data started. Powell's testimony was a study in calibrated optimism. He didn't come out with a fiery, hawkish tone ready to crush inflation at all costs. Instead, his language was measured, confident, and, crucially, reassuring. He stated that the Fed is now more aware of the risks of keeping rates too high for too long, which could unnecessarily damage the labor market and the economy. He acknowledged that the labor market has cooled considerably from its extremely hot post-pandemic peak and is now back to a state that is tight but not overheated. Most importantly, he gave a clear signal. He said the Fed no longer needs to see inflation data getting better. They just need to see more good data to gain the confidence to start cutting rates. This was the green light the market was looking for. It told investors, we see what you see. We are on the same page. The next move is a cut, and we are just waiting for confirmation. So, how does this verbal maneuvering from a central banker in Washington, D.C. directly impact the house you want to buy in Ohio or the condo you want to sell in Florida? The mechanism is stability and certainty. Think of it this way. For a homebuyer, the absolute worst environment is one of extreme volatility and uncertainty. When mortgage rates are swinging wildly from 6.5% to 7.5% and back in a matter of weeks, it's impossible to make a sound financial decision. Do you lock in a rate today or gamble that it might be lower next week? This paralysis is a poison to transaction volume. Powell's testimony acts as a stabilizer. By signaling that the Fed's next move is likely a cut and that they are data-dependent, not guess-dependent, he creates a framework for predictability. Lenders can price that expectation into their longer-term models. This doesn't eliminate daily fluctuations, but it dramatically reduces the risk of another violent, unpredictable spike in rates. For a mortgage broker, this means they can advise their clients with more confidence. They can say, the trend is now firmly pointing downward. While we might see small bumps, the Fed has all but confirmed the direction of travel. This encourages buyers to get off the sidelines and engage with the market. For the housing market overall, this, Powell put, the implicit guarantee that the Fed is now focused on supporting the economy rather than crushing it, replaces fear with calculated optimism. It assures everyone from first-time homebuyers to large-scale institutional investors that the era of relentless, shocking rate hikes is over. This psychological shift is just as critical as the incremental drop in the mortgage rate itself. It's the difference between fearing the market and strategizing for it. Powell's words didn't just describe the change. They helped to actively engineer the confidence needed for the recovery to begin. The French connection: how a European election lowered your American mortgage rate. Now, this is where the story gets truly fascinating and demonstrates the deeply interconnected nature of our global financial system. Our third event didn't happen in Washington or with a U.S. economic data release. It happened in Paris. The outcome of the snap parliamentary elections in France delivered a shocking result: a hung parliament, with no single political bloc securing a majority. Initially, This political uncertainty sent shivers through European markets. The fear was that a far-left or far-right victory could lead to unsustainable spending, higher deficits, and a crisis of confidence in French debt, the second largest in the Eurozone. But the result, a political deadlock, was ultimately interpreted by markets as the best-case scenario for dysfunction. It significantly reduces the chances of any radical, market-unfriendly fiscal policy being passed easily. Almost immediately, the perceived political risk in Europe subsided. The euro strengthened, and European stocks rallied. But the most crucial reaction, and the one that matters most for us, happened in the bond market. European investors, feeling more confident about stability at home, didn't feel the same urgent need to park their money in the world's safest asset, the U.S. Treasury bond. This is the critical link. You see, U.S. Treasury bonds are the bedrock of the global financial system. In times of global uncertainty or crisis, international investors engage in a flight to safety, pouring capital into U.S. government debt. This high demand drives up the price of these bonds, which in turn drives down their yield. Remember, bond prices and yields move inversely. So, when the risk of a crisis in France faded, that flight to safety trade began to reverse. The relative attractiveness of U.S. Treasuries compared to European bonds decreased slightly. With less frantic international demand, the pressure that had been helping to keep U.S. Treasury yields artificially lower eased. But wait, you might be thinking, wouldn't less demand for U.S. bonds cause their yields to rise? In a vacuum, yes. However, this event did not happen in a vacuum. It was completely overshadowed by the massive, dominant force of the stunning U.S. CPI data and Powell's dovish tone. The calming of European political risk didn't cause a sell-off in U.S. bonds. It simply removed one of the key forces that had been supporting them amidst the Fed's hiking cycle. The result was an additive effect. The powerful CPI news was the primary driver that sent U.S. Treasury yields plummeting. The French election result acted as a secondary tailwind, ensuring there was no countervailing force from abroad to blunt the fall. It allowed the yield on the 10-year U.S. Treasury to fall freely and decisively. And as we have now firmly established, the 10-year Treasury yield is the fundamental benchmark for the 30-year fixed-rate mortgage in the United States. Its downward move is directly passed through to American homebuyers. Therefore, a political event in Paris, by calming global investors and subtly shifting international capital flows, inadvertently contributed to lowering borrowing costs for a family looking to buy a home in Dallas, Chicago, or Seattle. It's a powerful reminder that in today's world, you cannot understand your local real estate market without paying attention to the swirling currents of global politics and finance. The walls between these worlds are far thinner than they appear. Navigating the new market reality, your move. So, let's bring it all together. Over the past week, we've witnessed a powerful convergence of events that has fundamentally reshaped the landscape for U.S. real estate. First, the CPI data provided the hard evidence that inflation is in a decisive retreat, giving the Federal Reserve the confidence it needs to pivot away from its restrictive policy. This is the fundamental driver. Second, Jerome Powell's testimony provided the crucial narrative, using the art of forward guidance to stabilize market expectations and assure everyone that the era of hikes is over, replaced by a patient but clear path toward rate cuts. This provided the psychological certainty the market craved. And third, the French election results offered an unexpected global assist, reducing international risk and allowing the bullish momentum in the bond market to proceed unchecked, further pressuring mortgage rates downward. The collective impact of this triple shock is clear. The lock-in effect is weakening. Mortgage rates are on a downward trajectory, buyer demand is poised to surge, and transaction volume, the lifeblood of the market, is set to increase dramatically. We are likely at the beginning of a new cycle, one defined not by frenzied speculation, but by a return to a more normalized, active market based on improving affordability and regained confidence. But this analysis is just the beginning. The real conversation starts now. I want to hear from you. If you're a potential buyer, does this shift make you more confident to start your search, or are you waiting to see if rates fall further? If you're a homeowner, does this make you reconsider selling your home, knowing more buyers might be able to qualify? If you're an investor, how are you adjusting your strategy for the second half of 2024 based on this new outlook? Let me know your thoughts, your questions, and your situation in the comments below. What's the biggest challenge you're still facing in this market? This is a rapidly evolving story, and your perspective is invaluable. Make sure to subscribe and hit the notification bell, because we'll be monitoring these trends closely and bringing you continued analysis as this new chapter for U.S. real estate unfolds. Thank you for watching. This is Your Name, helping you decode the market. Until next time.